Hi, Matt. Hi, my name is Akiba Leisman. I'm the CEO of Mako Mining. And the way that I like to describe Mako is that we're doing three things in northern Nicaragua. Firstly, we have now commercialized what is the highest grade open pit mine in the world. We are using the cash flow from our initial 500 ton per day mining facility to go and develop a discovery that we made a couple of kilometers to the south of our primary San Albino mine, an area called Las Conchitas, with the objective of us making a decision to expand production capacity to 1,000 tons a day by the very end of this year, and by late 2023 to be mining and processing at over 1,000 tons a day. And then what I find to be the most important part about Mako is that we do think that we're sitting on an orogenic gold mining camp. So we just announced a $17 million self-funded exploration program. And over the course of the next few years, we intend to announce a multitude of discoveries across our 188 square kilometer land package to prove that this really is an orogenic mining camp, district, and system.
Akiba, good to have you back on. Been a while.
Sure.
Last October, but that's fine. You made an announcement back in 2019, laying out your strategy and plans. We are kind of 3.5 years later. Do you think you've delivered on that?
Yeah, certainly given what has happened in the world, right? So remember, I think that's an important time frame that we announced this plan on. So I took over as full-time CEO in August of 2019. And then we decided to do the initial construction decision for the 500 ton per day plant immediately thereafter. And 6 months into the start of the mine's construction, the world went into a once in 100-year pandemic. I would say 70% through our construction, we got hit by two major hurricanes. Those were hurricanes number 8 and 9 over the last 100 years that hit the mainland of Nicaragua. And even with that, we were able to deliver this mine and project more or less on time, more or less on budget. And really there to lay the strategy in place, which was to use this relatively small scale mine, albeit one that's extremely high grade and extremely profitable, to go and use that to self-fund our other two objectives, to get this thing up to scale at 1,000 tons a day, and then to prove that this is an orogenic gold mining camp. The last time that we raised equity capital was at actually almost exactly 2 years ago in July of 2020. The last time we raised debt capital was in early 2021. All of that has been fully repaid through the cash flows coming from the mine. We're able to not only run our business, but to reinvest and turn this thing into a really special mining company.
Right. Okay. So yeah. Okay. Difficult period for everyone. I think the bit that I'm keen to understand is 500 ton per day plant. It's not very big, right? You are processing high grade gold. You are generating revenue. You're selling gold. Q1, $1 million of net loss. Your all-in sustaining is just over 1,100. Was that just an anomaly in Q1, or I guess what I'm trying to work out is how do you produce enough free cash flow to actually fund this expansion program, which you're quite keen to demonstrate to the market? Okay,
so now we're talking on multiple sides of the financial statement. So we're talking about income, we're talking about cash, and then also we're talking about comps in terms of where we've been and kind of where we're going. So let's look at it in the context of last year, where we declared commercial production July 1st. So all of Q3, which we were still in ramp-up mode, we were really only operating at about 80% capacity. And then Q4, we were basically running at our 500 ton per day level towards the end of the quarter. So in Q4, we sold just under 9,600 ounces of gold. We generated just over $8 million of adjusted EBITDA, just over $9 million of mine site cash flow, and we generated positive net income of just under $3 million for Q4, with all-in sustaining costs of just over $830 an ounce. In Q1, we sold almost an identical amount of gold, just under 9,600 ounces of gold, and we generated just under $9 million of mine site operating cash flow. So it was a little bit lower than Q4. We generated just over $8 million of adjusted EBITDA. So it was a little bit under Q4. And then the all-in sustaining costs went up from the $830 to $1,100 an ounce. Some of that was real. So some of that was actually real cost inflation, where our input costs, diesel specifically, added to our operating costs. Likewise, we went from a strip ratio, which was below the normal rate of the life of mine plan. So roughly about 17 or 18 for last year on a life of mine plan of 23 to 24 to 1. And then the last quarter over at Q1, we were up to 30 to 1. So there was actually an element of strip, so mining costs that increased as well. Collectively between the two, that increased our cost per ounce just over $100, thereabouts. There was another element that was due to some ways that we were actually depleting the asset. We went through a different partner over at PwC, had different ideas on how to do our depletion model. So a lot of that did have an acceleration of our depletion that caused our net income to go from positive to negative. But the actual change in cash flow from quarter over quarter was really just about $1 million different from Q4 to Q1. And at these rates, I expect them to maintain itself going forward for the mine.
Right. Is that going to be enough to allow you to do what you need to do for the market? Because what's happened to date has been a demonstration of it's a kind of route to market, right? It's a demonstration that you guys can build a mine and operate a mine. So that's really good. But you now need to demonstrate scale, and meaningful sort of change in the economics too. That presumably will come with that. So do you envisage having to wait an extra couple of quarters because costs are going up, whether it be fuel or because things come along because it's mining which affect your ability to maintain steady state economics? I mean, how do you see the rest of this year or the next 12 months panning out on that front? I mean, what are you doing to kind of mitigate some of that?
Sure. So I have no idea whether input prices are going to go up or down from here, but let's take a look at what happened in Q1. So after most of the effects of the increased global inflation, commodity prices going up, what we were actually able to do with the roughly $8.7 million of mine site cash flow, the roughly $8.3 million of adjusted EBITDA that was coming from the mine, we were able to not only fund our operations, like that's first and foremost, we were also able to repay US $4.6 million of principal on our balance sheet. We were also able to finance $1.9 million of exploration, growth exploration. None of it is associated with info work over at our asset. We were able to repurchase roughly $100,000 worth of stock as well during this time. We were able to acquire and add to our balance sheet an additional $2 million of surface rights for some of our expansion plans to the south over at Las Conchitas, as well as to the north over at Las Segovia, all coming directly from the cash flows of the mine. So the 500 ton per day facility is capable of doing everything, not only funding our growth objectives, not only being able to fund our business, to repay the debt on the balance sheet, but also to have additional capital left over for shareholders' returns.
Right. Okay. 4.6 million of principal repayment in Q1, fantastic, and 100,000 of share buyback, neither here nor there. People are looking to you to kind of show the growth component, not the standing still component of what the revenues drive. Because it's non-dilutory. You're not asked, you haven't raised money in 2 years, which is awesome. But it's the how much more than 1.9 can you put into the exploration or purchasing of other additional land packages, and when does that start kicking in terms of meaningful addition to creative growth, whatever you want to frame it, for the company and this kind of element which the market's looking for. Because if you look at the stock, it's been a tough few months, 3-4 months for natural resources in the market more broadly. It's been kind of sideways movement as you've demonstrated that you can build a mine in a tough environment, admittedly. But where's this kind of growth element come from? Because you kind of saw fantastic growth in 2019 and 20, and you kind of, I think people expect you to be able to kind of pull it out of the bag and do more of the same. So what's that going to come from?
Sure. So let's talk about what scale actually means in the context of what we're capable of doing organically through Mako, and kind of what it means kind of in the long term about what the ideal positioning is for a public company that's participating in the gold exploration, development, and production market. So in terms of what we're capable of doing, San Albino, the primary mine that we're developing right now, will have somewhere in the neighborhood of about anywhere from 2 to 4 separate, relatively small scale pits. It's never going to be more than 500 tons per day coming from this area of about 0.8 square kilometers on our 188 square kilometer land package. We've demonstrated that we're able to mine enough mining faces to consistently, without depleting stockpiles, to get this up to 500 tons per day of super high grade mill feed, right? So we're capable of delivering head grades that are averaging anywhere from 7.5 to 9 grams a ton at our 500 ton per day run rate. That will equate to low 40,000 ounce a year production, and then it will generate mid 30 to maybe high $30 million a year in cash flow. That is not sufficient to be a large scale mining company by any stretch of the imagination. That was also never really our business plan. Our business plan was to use San Albino as a proof of concept. And it's not just from a bootstrapping approach. I think that word and that term is used too often in this industry. It's usually an indication that things aren't developed in the correct way. This happens to be an ore body and a system that is frankly unique, right? So we kind of needed to go and look at San Albino. First and foremost, get the resource correct, understand the geology, make sure that we understood what we were looking at, and then use the analogs and the ideas, mining techniques, processing techniques on dealing with this type of material and this type of geology over at San Albino, and apply it to the rest of the property. So with that foresight, we were able to change some of the civil works for our plant, that when we are ready to make the decision, with a standing start of about 8 months, less than $5 million, we'll be able to expand our plant to 1,000 tons a day. But it will require us mining from a completely separate area, the most advanced of those areas being the southern part of Las Conchitas, about 2.5 kilometers away from the plant. We now have 5 rigs over at site. 2 of them are focused on resource delineation over at southern Las Conchitas. I would say from an internal perspective, by the end of this year, we'll have a mineable resource on Las Conchitas. And by, let's call it Q1 next year, we'll have a public updated resource that will take everything that we've done, both at Las Conchitas as well as San Albino, and even potentially elsewhere in the property for an updated resource. But we'll be able to make that decision to expand to 1,000 tons a day this year, and then to be mining and processing at that level by H2 of next year. Now, at 1,000 tons a day, just to let me finish this particular point, that's still not a very large mining company. This is all going to be, at maximum, going to be somewhere between a 75 and 90,000 ounce a year producer when we make that expansion rate. Now, this is different than a normal 75. It's different than a normal 40,000 ounce a year producer. This is also going to be different than a normal 75 to 90,000 ounce a year producer, in that the real margins that are being generated from this asset, that is clearly demonstrated by our lack of need to raise capital for the last 2 years on the equity side and the last year and a half on the debt side. It's clearly the margins coming from this mine are a different level than what you would experience from our competitors. Now, that being said, in order for this to be a company of relevance, of materiality, there's going to have to be some external activities at the company through M&A. And I'm indifferent about whether that happens on a merger, an acquisition, a sale. For us, it really is, how do we best position ourselves in the long run, now that 5-year plan is basically about 60% de-risked at this point?
Okay, point to me the things that are important here, because like I say, I don't want to view this as a kind of standing still or learning on the job exercise that you've been through. I want to say, right, we've demonstrated to the market that we know how to efficiently mine in this district, this region. You're allocating exploration capital. You've talked about allocating 5 drill rigs at Las Conchitas, which is great. But what does that incremental gain by going from 500 ton per day to 1,000 ton per day mean for you, given the sunk costs that have already been invested? What's the meaningful upside in cash terms, or however you want to define it? What should I be looking at?
So I haven't seen anything materially different in terms of the geology, the grades, the thicknesses on anywhere of a property, whether it's 2.5 kilometers to the south at Las Conchitas South. We announced a discovery 700 meters away from the mill to the north. There's clearly mineralization that this year we're highly confident that we'll announce a discovery over at Segoviana that looks 20 kilometers away from the plant, that looks identical to what we have over at San Albino. So what we're doing now is going to be very similar to what we're going to be doing in 2 years, in 5 years, in 10 years, in 20 years, as we're going to be mining this orogenic system for the long run. So what does that mean in terms of return on capital? So like I said, from a standing start fixed infrastructure, so actually making adjustments to the plant. So that doesn't include drilling costs, and it doesn't include surface rights acquisitions and things of the sort. But specific to plant adjustments, it's going to take less than $5 million to get this up to 1,000 tons a day. There are certain synergies about processing at 1,000 tons a day that it would be that incremental 500 tons per day will be of less cost than the first 500 tons per day, not because the material is any different. It's just because our overhead is basically the same. You'll probably be a little bit more efficient on consumable usage and this thing. Back of the envelope, I think we were estimating that the marginal 500 ton per day increase would have about a 25% lower cost. So the overall 1,000 tons a day would have a 10 to 15% less cost on an all-in basis on that front, which I think are realistic numbers for that to happen. But it's not like we're going to be finding something that is different than what we're doing right now. It's just going to be, this is a system that is particularly well suited to incrementally and basically methodically to add additional discoveries and mining fronts over the years and decades to come.
Brilliant. Okay, okay, I got a number out of you. That really helps. And just on that front, so $5 million goes from 500 to 1,000. Is this a modular plant in the sense that can you go from 1,000 to 1,200 or to 1,500? With similar sorts of costs, or does it radically change?
Yeah, so I post pretty frequent pictures on my Twitter feed, on our website, and you can see that we built this 500 ton per day plant kind of in a little tight area over here. That 1,000 tons a day is going to be knocking on the limits of space in terms of what we have. So I think where we have built and designed the plant itself, it's not going to get larger than maybe incrementally bigger than 1,000 tons a day because we're more efficient, but it's not going to be more than slightly more than 1,000 tons a day when all is said and done. That wouldn't necessarily preclude us building a completely separate plant elsewhere on the property if we make a particularly large discovery somewhere or the other. But that's not our base case, nor is it, I think, feasible over the course of the next 5 years to be mining and processing at a rate greater than slightly higher than 1,000 tons a day for the long run. So I do think that this particular iteration of Mako and San Albino / regional exploration will be a plan to get to that 75 to 90,000 ounce a year of production, albeit one that will be generating in excess of $1,000 margins.
Got it. Okay, great. A lot of numbers we can work with there to kind of value this thing. So you at that point you'll be banging your head on a ceiling, and you need to do something significantly different. So the two things I'm looking at here, obviously, the financial situation, you're paying down Wexford and Sailfish. How much more to go on that? So
we currently have $7.8 million of principal to Wexford. We just made our 10th payment to Sailfish. I think we're right at 3,000 ounces there. The Sailfish one is self-amortizing at 205 ounces a month. So we got another 14 months left on that. And then the Wexford we're repaying as quickly as possible. So whenever we have excess cash, immediately it goes to principal repayment to Wexford. Right. After we spend money on exploration, et cetera.
Right. So let's share with people the upside and the rationale for paying off Wexford. Obviously you're ex-Wexford yourself. You know, the money came from them originally. They needed their money back and they want it back quickly, but you're under no pressure to affect your business from being effective at what they do. Wexford are not putting you under too much pressure, but there is a kind of payment plan which will pay off over, well, give me a clue. I mean, when do you think you'll pay it off by?
Right. So for anybody that deals with Wexford always puts pressure, right? But it's just not pressure that give me my loan back now. It's more of a pressure is that, come on, guys, we got to get on this. We have a plan. We need to execute on these things. Enough talk and kind of more action. That's the type of pressure that they bring as a controlling shareholder. Our desire to repay Wexford is really twofold. One, it's clearly economic, right? So it's a relatively high cost facility. The interest rate is ratcheted up to 10% from a year and a half ago. And then on top of that, they're entitled to a gold bonus on a prorated amount of principal that's outstanding relative to the original principal of 15.15 million. So now that it's down to cut in half, they're entitled to roughly 250 ounces of gold if that's left per year. So there is a huge economic incentive for us to repay it. Likewise, and this is kind of on the benefit side of Wexford, we can make decisions by having a debt provider that's also a controlling shareholder over there to run our balance sheet, frankly, more aggressively than we would if this was a completely independent relationship. And by that, I mean, we really do run our cash balances somewhere between $500,000 and $3 million, depending on when you get a gold shipment. And then once we actually spend money on our growth objectives, so obviously fund the business and do what we need to do in terms of investing in capital and exploration, to deliver on our three-stage plan, is that really everything else can be used for principal repayment. And if for whatever reason there's a hiccup, let's say we have a particularly bad rainy season, which started a couple of weeks ago. Let's say this or that happens with the plant. Well, at that point we can always readjust. Now, once the debt is repaid, then we're good. We're good to go. We can run this thing more as a normal mining company, and then have, I would say, more deep and third party relationships on the lending side as well. That'll be fantastic. But right now, in terms of what is good for Mako today, and certainly what has been good for Mako over the last 3 years, having a shareholder with access to capital, having a debt provider that gives all the flexibility that we need to deliver on our business plan has been a godsend for this company.
Yeah, it's kind of catch-22, isn't it? It's a godsend, but it's also, as you say, there's the little dig to the side occasionally saying, right, we want our money back. So and I wanted you to be able to explain that to people, because people will be looking at the exploration budget and going 1.9 million, like going, could be doing more, boys. But you're saying it's more in the company's interest to get rid of this facility as quickly as possible, without obviously in creating the company's ability to actually do business, than spend more money on exploration for now.
It's actually not even that, right? So if anything, right, it's been getting the rigs logistically over its site. So we announced our $17 million exploration program, and you can see in Q1 we spent just under $2 million in exploration. Like 2 million times 4 ain't 17, right? So clearly we were spending less than kind of like the run rate, albeit we announced that program in March. So it really only was in effect for about a month. The reason for that was not because Wexford was putting their hands up saying, you guys got to pay me today. The reason why that happened is we literally couldn't get rigs to site for a whole host of reasons. Now we actually have our 7 core rigs, 5 of which over at Las Conchitas turning, and then that exploration budget is going to be expanded, all of which with the blessing of the controlling shareholder.
Okay. Sorry. So the 1.9 I'm referring to were the exploration and evaluation expenses for Q1. You've now got 17 million bucks you're allocating. So there's a big number there. The other, and obviously, I think Q1 you talked about 2 million or so on regional expansion for surface rights, for regional expansion. So there's the kind of growth bit. The second thing, so there's Waterton and Sailfish. The second thing you mentioned there was where the growth part of this story comes from is the M&A. But again, timing on that's going to be important as well. You've got to have the kind of the cash reserve so it doesn't become too expensive, or access to cheap capital, which right now in this market is, I'm not sure what you think of that. And you've obviously got to find the right projects to go for. Or you turn around and say, well, actually, we've got enough for land package here. We're confident what we've got in front of us, and we can build this into a plus 100,000 ounce a year producer ourselves. So, what's it to be, do you think?
So the baseline in terms of what we can actually underwrite is what we own, right? So our baseline assumption is that we are going to be growing San Albino to get to the 1,000 tons per day, prove this is an orogenic mining camp, and then be operating a 75 to 90,000 ounce a year producer with eventually all of the exploration potential to be mining at that level for generations to come. That being said, there's a lot of benefits to doing external M&A and on all three ways of doing it: acquiring, merging, or selling it at some point. We're always on the lookout for projects that make sense, which is always the most difficult part. And that was one of the items that he put up. Most of the projects don't make sense for us, either in terms of asset quality. We're not going to be diluting the quality of our asset. Transactability, our ability to go and fund, you mentioned that, or even a willingness to do something with us, which has always been a challenge for companies that we've interacted with. That being said, we've actually been very successful at doing M&A over the course of the last 10 years. Mako was created through M&A. There needs to be a fit from a people perspective, et cetera. And then likewise, there has to be an opportunity that makes sense for both parties. And then that is determined based on the general state of affairs in the market. I think we're fairly good and practical in that if, let's say, we're trading at X and they're trading at Y, and then both of us are trading at half X and half Y, to us that's identical in terms of merger opportunities. So we're pretty good about not looking at notional prices that are being paid for assets, but rather what are effective and fair splits when you're talking about M&A. But I do agree with you that there are a lot of assets with that makes sense to kind of put in the fold that we just can't transact on just because of the relative valuations of companies. And that's okay. And if we can't do that, well, we have this wonderful asset that we have this wonderful growth platform ahead of us. But we're always kind of attuned to the market if there are opportunities on the outside to look for.
Right. And coming back to Wexford briefly, this is really in terms of liquidity. Your narrative in the market. I mean, Wexford looking to offload any of this at any time soon? Would that make your story a lot easier to tell, certainly with the institutions, if they did? How are you managing that side of things?
Yeah, on the Wexford angle, you mentioned it's always a catch-22, right? So I could say emphatically that there were 100% beneficial things that this company had that would not have been there if it was not for Wexford. And frankly, going back even way before 2019, when this was two separate companies, we would not be here. We would not be mining. We would not be generating $8+ million a quarter of cash flow if it was not for Wexford. There are potentially negatives that come from having a controlling shareholder. Almost by definition, if somebody owns 56% of you, the liquidity of your public stock is going to be less than half of a similar sized company else, just purely mathematically. I do think that there are a lot of misplaced criticisms in the market in terms of some of the issues that people have had with this particular share structure. Because at the end of the day, there really hasn't been any single decision that I've personally made, that Wexford has made, that hasn't been for the direct beneficial interest of all shareholders, especially the minority over here, ever since we've been involved over at the company. That being said, it's also helpful to have what is essentially a single voice, if you will. Is that if, like, for instance, Mako was created through a very, very complicated merger. It was effectively a four-way deal that created it. I won't rehash the complete history over here, but for the size of the companies that were involved, it was an extremely complicated transaction to transact on. But the fact that there was a single voice on three of the four sides over there, we were able to negotiate the deal really over the course of a period of 24 hours when the other side kind of had their come to Jesus moment, and we were able to negotiate as adults over there. It is useful to have a company that has not only the funding capacity, but also has the ability and credibility to advance natural resources companies from inception stage to some of the biggest natural resource producers in the world, right? And inclusive of a member of the S&P 500 was created by Wexford. And I do think that people have always discounted what the benefit of having a shareholder like that is. For us, it's been, at least from my particular perspective, has really been nothing but positive.
Right. Okay. Well, like I say, people have their own views about having a large shareholder can do for the register. But okay, you've argued your case. Can I just want to talk about one of the headlines I saw recently, which was some super high stuff. I mean, 51.8 grams of gold and 29.8 grams of silver over just under a meter, right? That catches the eye. The grades do anyway. The width's not so much. But what are the lessons you've learned in terms of running the company over the last 3 years? Because obviously you've been demonstrating your ability to mine, right? And you've done it, and you said that was what you set out to do. Okay, so San Albino is there to say we know what we're doing on the ground operationally. What have you, as a CEO, learned in terms of talking to the market and setting expectations? And certainly, when you see headlines like that, I think in 2020, maybe the market would have gone slightly nuts and misunderstood what you were trying to say there. So how have you changed in terms of the way that you talk to the market over the last 3 years?
Well, it's actually there are a lot of valuable assets to have a cash flowing mine, like literally next door to a discovery. One of the definite side benefits is that we can provide as clear of context as what it means to make a discovery elsewhere on the property because it's the same stuff. So everybody knows exactly what it's going to be. Over at San Albino, we are mining veins that are averaging somewhere between 1 and 1.25 meters wide. Now, the average vein of San Albino is probably grading about 16 or 17 grams. But we have established, and this even goes back before 2020 when we started mining over at San Albino, really over the last 5 years, we've established mining and grade control protocols over here that we can control open pit mining dilutions to less than 25 centimeters. When we created that resource in 2020, we applied a 50 centimeter dilution estimate. That's why our resource grade was 9.58 grams a ton, as opposed to the 16 grams that are coming out of the mine right now. But we've been controlling dilution to this thing to 25 centimeters. So when you make a discovery hole over at 51 grams, and I'll go over a little bit about why this discovery was made at the time that it was in a second, but 51 grams a ton over 0.9 meters true width over there. You dilute that 25 centimeters on either side, you get a little over an ounce material at 1.4 meters. And you would try to demonstrate that to people 3 years ago, and they said, no, you're going to dilute that more than that. No, you can't do that. No. Clearly you can't. Guess what? We have a mine. We're doing that literally next door. You can't say that anymore. Actually, the last time, so it's a funny anecdote. Like, the last time that we actually had a major or mid-tier mining company that did even a beyond cursory level of due diligence on us, it was in 2019, and we were like going over this very detailed grade control and open pit mining protocols that we have in place. And we told them, it's like, look, and this is at the time where the internal resource model, the geological model, was put in place. They agreed with basically every bit of data that we had on the geological model. And they said, now, when you're going to be mining, this is going to be 3 grams of the head grade. And we're like, no, this is how we're going to be mining it. This is going to be a 7.5 to 9 gram head grade mine over here when we blend everything together. Now 3 grams. Clearly, we were right, but we didn't actually have reality to go and argue our case. Now we actually have a mine next door. Is that you don't believe us on what's going on over at Mina Francisco, this new discovery over here? Well, guess what? We have a mine 750 meters away that's doing that right now. So this is actually a very, very real discovery, and the economics are going to be looking as good, if not better, than what we have over at San Albino. Now, the reason why this was actually discovered when it was is that we were running out of space on our waste dump. So we needed to go and find a place to add waste tons to. So we found this beautiful ravine on the north part of Las Conchitas. It was by far the least amount of drilling that we had in the Las Conchitas area. The most advanced part is Las Conchitas South, about 2 kilometers away from where we're drilling right now. But there was an urgent need to do some condemnation drilling work on this new waste dump that we needed to permit. Lo and behold, the first hole that we put in hit this beautiful vein. It was over 3 meters wide, true width, hit double-digit grades. We got the results back maybe 6 or 7 weeks ago. We put it in the press release today, and we were like, "Uh-oh, we may have actually decondemned this waste dump." But then we actually started playing together with the geological model over here. This did not look like it was fitting to what was known about before. We had our geologist walk the ground a few hundred meters up dip over here. He found some float that was grading a couple ounce material, and then we started to drill up dip and a little bit deeper over here. And then lo and behold, 15 holes later, we made the discovery hole over at Mina Francisco. And we've now traced that to 200 meters plus of strike, 330 meters of dip. This is right now about 60 to 70% of the size of at least the geometry of San Albino proper, and completely open in all directions. And the only reason why we made a discovery here in the first place is because we needed to go and condemn a waste dump. This has nothing to do with the more advanced location over at Las Conchitas South, which we can put a resource on that today if we want. This has nothing to do with 20 kilometers away over at La Segoviana. And it just shows the prospectivity of this ground is that if you actually spend some time, effort, money to go and do the drilling, there are going to be a multitude of discoveries that are going to be made, not only this year, but year in and year out for decades to come.